Thanks everyone for joining us for today's panel. We're really excited about this afternoon's conversation around demystifying corporate venture capital. And thanks to Techstars as well as TRUIST on the corporate innovation track for putting together just a great week of content. We hope that you all have been enjoying the week so far. My name's Noelle London. I am with Accenture Ventures. So our team is helping our Fortune 2000 clients with innovating through startup partnerships. And in some cases, we are also making strategic minority investments in companies as well. So in this session today, we're going to talk about what motivates corporate venture capital. We've been building this week talking about corporate venture capital best practices, kind of breaking down some of those tips and tricks and designing of programs. So in this session, we really wanted to bring together two of the best to talk a little bit to us about what is motivating their work and to give us a little bit more information on what is motivating corporate venture capital. So without further ado, I want to turn it over to two of the best. So Vanessa and Mike, can you go ahead and introduce yourselves?
Vanessa, ladies first.
Sure, thanks. Hi, I'm Vanessa Vreeland, and I run TRUIST Ventures. And I've been at the helm for about 9 months now. Oh, I guess it's actually 11 months. We were just talking about how we can't believe it's already November. So almost a year. But I've spent my career in private equity and venture capital, supporting both early stage and mature stage companies and also investing in funds. And I was really excited to come to TRUIST and help them start and build a program that's leveraging their legacy programs from both Heritage BB&T and Heritage SunTrust. So recently relocated to Charlotte with my family and happy to be here speaking with all of you. And Noelle, you guys have a really impressive program too. So thanks for the compliments, but we aspire to be like you guys as well. So thanks.
Lots to learn from each other. Mike, over to you.
So I'm Mike Mahan. I'm on the ventures team at Stanley Black & Decker. I come from the startup world. I spent about a decade there over a couple different startups in the banking and healthcare sector. Joined Stanley back in 2016 when our team was first stood up. We're a diversified industrial, but I work primarily with our tools group. It's been a fun ride to be a part of a team that just has started, and we were sort of a startup within a big enterprise, and now we've got about 40 portfolio companies and starting to hit our stride. So I'm based out of Atlanta, and this is actually where I'm from, so I'm local, and it's nice to be with everyone today.
Great. Well, just as we're getting started and setting the stage, would be helpful, I think, to define what we mean when we're talking about corporate venture capital. How is it different from traditional venture capital investing? So Vanessa or Mike, either of you want to jump in and just help us kind of define and set the stage?
Sure, I'm happy to jump in on that one. So corporate venture groups are all different actually within themselves. But to label it very generically, corporate venture groups often have a strategic component to their investing criteria that's aligned with the objectives of the organization. And so unlike traditional venture groups who have specific subsectors or industries where they may invest, they're really focused on ROI. And that's not to say that corporate venture groups aren't also focused on ROI, but typically, corporate venture groups are also looking for some other angles, some other strategic relationships with the companies in which they invest. I'd love to say that the differences stop there, but unfortunately, corporate venture groups have gotten a bad rap for not being as nimble or as fast as some of the VC groups when it comes to fundraising. And so I know that on this panel, we at least pride ourselves on the ability to move more quickly than other traditional corporate venture groups and can keep pace with the industry outside of corporate venture groups. So those are the primary differences. I'm happy to talk about specifically what we're doing, Noelle, if you want to take the conversation there, or we can get to that later in the conversation.
Yeah, let's do that. I think it'll be interesting to hear about how your strategies and your thesis is different across your two organizations.
Sure. So I'll talk about TRUIST, and I know that Mike's is a little bit different, so it'll give the audience a flavor of how even corporate venture groups can differ within organizations. So at TRUIST, we're really helping to drive innovation across the organization. I mean, we're out looking for technology that can enhance our touch with our clients, thereby building additional trust with our clients, continuing to build our trusted relationships. You know, financial services has long been a relationship-oriented business where meeting in person and developing relationships has been really important and is a core fabric of who we are. And as we move more from in-person meetings to more digital channels for our product and services, we're looking to do that in a very personalized and authentic way to connect with our customers. But as you know, BB&T and SunTrust came together to develop TRUIST to invest in technology and to bring better and best-in-class products and services to our clients and to our employees. And so TRUIST Ventures is really out there looking for products and services that we could bring into our own product suite and roll out to our customers. You know, in addition to looking for products and services that we can offer through commercialization partnerships, we're also looking to learn. I mean, we acknowledge that we're really good at some things, but not awesome at other things. And TRUIST Ventures is one of the windows outside of the outside of the organization, really looking for cool, innovative ideas that could have nothing to do, presumably, or on the surface with banking, but could be something that we're really interested in investing in just because we want to learn about it. Our third pillar is really focused around social change. We want to build a portfolio that's as representative and diverse as the clients that we serve. So we're constantly looking for entrepreneurs who are serving different markets, who have themselves different backgrounds, so that we can best serve all of our clients and customers. And then while we do that, those three things, we're really focused on doing that on a foundation of financial discipline. So we're not ROI driven per se, but we're certainly not looking to lose money for the organization. So that's a little bit about TRUIST Ventures.
There's nothing strategic about losing money, is there?
That's right now.
So at Stanley, our strategy is really our mandate, I guess I would put it, is to grow Stanley's top line and grow a startup's top line at the same time. So, you know, my process really starts with the business and understanding not only the commercial initiatives they have, but, you know, the customer problems that they're trying to solve and, you know, gaps in technologies that they might have. And we go external to Stanley to try and bring outside innovation inside of Stanley by way of partnering with startups. You know, first and foremost, that is our main strategy. And we like to work with startups at a pretty early stage because oftentimes we're looking at hardware or hardware-enabled software, and getting a startup company from to actually commercialize a product that's in a hardware type setting is extremely difficult to do. And that's a place where we've got incredible amount of experience and expertise and a long history of doing this very well. And so we add a lot of value to earlier stage startups, you know, by working with them to help understand how to launch something, launch a product in the hardware space. So really that's kind of our main strategy. I would say in addition to that, you know, again, our expertise being in manufacturing, we have, you know, hundreds of plants all over the globe, and additive manufacturing, 3D printing is something where there's not really a top line focus, but we know that additive manufacturing can disrupt how we build products down the road. So we invest in a lot of additive companies and technologies just to make sure that we don't get disrupted and we can participate in that disruption rather than being a victim of it. And I think the last thing that we do really from an investment perspective is we look at kind of macro technology type trends that could impact industries in general in the long term. And we research these areas. A good example would be like quantum computing. There's nothing today that we can do investing in a quantum company to grow Stanley's top line anywhere in the next 2 years, at the very least. But it's still a technology that is going to change the world, and we need to be close to it and learn from it. And so, we will make learning investments simply to make sure that we're staying at the bleeding edge, and learning about those things that have a longer horizon, while also making probably the vast majority of our investments into those, shorter term opportunities where we can partner and launch products together.
Yeah, it's fascinating, I think, just to hear, how those programs are different. I know on our ventures team, innovation sits in a lot of different places, within the organization, but our team's really focused on how do we help our clients innovate with those startup partnerships. So it's a little bit, not necessarily for internal usage, but how do we bring that innovation and help our clients with those partnerships? It's always interesting and fascinating to hear, how those programs evolve. Just one question on that is, how does your strategy line back to your businesses? This is a conversation I know I've been having with a number of peers recently on, when does it come from the ventures team? When does it come from kind of your business unit leads and they're championing a particular company and bringing it to you? How do you account for that?
So I can start off there. So for us, everything we do is sponsored by the business first and foremost. One of the key things that we do internally is we continuously remind the business that Stanley Ventures does not set strategy. We support strategy. And one of the reasons why that's extremely important is because we want the businesses to factor us into their strat plans. We want them to leverage us and use us to help accomplish their goals, not to have us add goals to their plate and to their plan, and change the direction that they want to go in. So that's so important for us, is to learn what our businesses are doing, the kinds of challenges that they have. It all starts with the business. And so kind of going back to, how are corporates different from traditional VCs? Well, our focus areas change quite often versus a traditional investor, or traditional venture capitalist, because our businesses are always coming up with new problems they want to solve. The customers are sending us new problems that they want us to solve, and technology continues to advance, and our teams have different needs at different times. And so much of what we do is driven by the business themselves. And then, I would say when it comes to like learning investments, that's really driven from the corporate level, and thought leaders like our CTO, who understand the larger, like I said, macro technology trends, and will bring those things to us to say, hey, this is an area we need to be familiar in, probably investing in. But again, that's not ventures driving that conversation. That's someone from corporate, and usually it's the business that's driving that conversation to us.
We are a little bit more of an 80-20 shop right now, and it'll be interesting to see as TRUIST continues going through the merger how we end up landing. But I would say about 80% of what we're focused on right now, similar to Stanley, is really driven by the business. And so we spend a lot of time working with our businesses and our business units, much like you said, Mike, to be top of mind for them, and so they can use us as a resource and think through where they might need external partners, so that we can go out and help them find those partners. So very similar. I would say the one thing that we talk a lot about, and one of our heads of innovation talks a lot about this, when Steve Jobs developed the iPhone, no one knew that they needed or would want the iPhone. Everyone was perfectly happy with the flip phone. And so we keep that in mind as ventures because we are out in the market. And so we do feel it's our responsibility to go out and find just really innovative things or to challenge the businesses to think, with outside of the box and what's within the realm of possible. And so that's a role that we've been asked to play in the organization. And we have a lot of fun with the businesses from that perspective. But I thought, Mike, you brought up a great point in terms of the difference between corporate venture groups and regular VCs. Absolutely. I think where we'll focus in 21 will be slightly different than where we focus in 22. And it'll all be within, financial services and tangential or adjacent technologies that support financial services, but the flavor will change depending on which business unit we're supporting. So that's a really great point.
Yeah, that's helpful to think about how the timelines are different. So in terms of just breaking this down, can you talk to us about, where one of these investments from kind of the sourcing piece up through investment and potentially, moving it into testing within a business unit? Tell us kind of what one of these life cycles looks like.
So I can speak to that. There's probably 3 different ways that we get deals sent to us. So first is naturally just organically through our team and all the other VCs we work with, universities, incubators, everyone like that. We will find companies and bring them to the business unit. And the second would be the business unit is actually working with a startup. Those are always my favorite because we already have the buy-in, right? And so that process is a little different. But honestly, the best is when a customer sends us a startup. Actually, they'll send it to a business unit who will then send it to us and say, hey, our customer would love for us to work with this startup company. We find a way to make that happen. Because then you've already got that market validation, at least in some way, shape, or form, and that's helpful. So, but for us, it comes down to let's make sure that there's buy-in at all levels, that it aligns with strategy, that the technology is protected. So for us, Stanley, IP is very important for our company. The patent board actually ranks us as like the 7th or 8th most innovative company in the country based on our IP position alone. So IP protection, particularly in hardware, is extremely important. So having your IP or your technology protected with IP is essential if we're going to launch a product on a large scale. So again, alignment with strategy, IP protection, and then is there a way where we can really add value to the startup? I would say that's kind of the last checkbox before we go in front of our IC investment committee for approval to really go forward. Is look, I know that we've got great abilities to take a product and launch it and everything, but if we can't add value to a startup, just a traditional hey, let's put our brand on it and let them go sell it. We want to be able to be more impactful than that. And so we look for ways where we can look for relationships where we can have a big impact on adding value to the startup. And usually that comes in the form of, us operating in a space that's not necessarily where the startup is trying to focus in their larger business plan. So people will say to me, oh, so I assume you're looking for the next greatest power drill. And I'll say, no, that's not. I kind of think Stanley will probably invent the next greatest power drill. What I'm looking for is technologies like maybe battery technology or electric motor technology. And these might be technologies where the startup is actually targeting a different space, maybe like electric vehicles, but we could take that technology and roll it out in the power tool space and impact our market while the startup still has all of their original business plan and the markets they wanted to target originally still available to them. And so does the relationship align well? Can we do something where you're not totally dependent on Stanley's success in order for the startup to succeed? That matters too. So, we go through all of that, from checking things off from an upfront diligence perspective, before we actually move into, really negotiating letters of intent and going through diligence and things like that. So that's really how our process unfolds from the beginning.
Yeah, I would say oftentimes we're trying to pilot and POC companies to see, how is this resonating with our clients? What does the implementation look like? Understanding, how would we add value, and what's the market potential before making those investments. So that sounds similar. We may have lost Vanessa temporarily, so I think we're going to try and get her back in. But we can keep the conversation going, Mike, in the meantime. So I'm curious, in the midst of COVID, we were talking about, how COVID has actually impacted Stanley's business. And curious to know, when you think about your investment thesis and your priorities on Stanley Ventures, how have they evolved given the last, I don't know how many months since March or so?
I would say that first and foremost, while venturing can be opportunistic, Stanley, we have a very measured approach to our strategy. And we always think long-term while taking into account what's happening in the short term. And for us, I would say it really did not impact us very much at all. For the most part, our business actually experienced quite a incredible phenomenon during COVID, where we were planning for the worst of things in construction shutting down and all that stuff, and people working from home actually ended up booing our business because everyone was at home and they looked around their house and said, hey, I've got, all these projects I've been trying to work on for the last 5 years, and I'm finally going to go and do them. And so individuals went and bought tools, and we're having an incredible year in the tools business, even with, the world, in the shape it's in, and construction in the shape it's in. So, a large part of our strategy for the year was not necessarily impacted too much. I would say that something like our security business, though, where we do commercial security in all different kinds of grocery stores, restaurants, pharmacies, commercial real estate buildings, where people aren't necessarily going into places like that. We had to be a little nimble there and try and find some opportunities, for a business where you're kind of dependent on people walking through a door, in order for there to be, customers. But outside of that, I would say we tried not to react too much to COVID and look longer term. VC is about long-term investing, and a lot of the startups we invest in, they're still in R&D or technology development, and they're looking 12, 18 months out to launch product anyways. And so we tried to maintain that mindset while, venturing out just a little bit, no pun intended, for some short-term opportunistic things, but not too much, I would say.
Yeah. Okay. I know we've bought a lot more tools this year than than we ever have. So, yeah. So just switching gears a little bit, because I know that we have a number of startups that are in the audience and a number of startups attending this week. So in terms of thinking about CVC, if you are a startup, when is it the right time to think about CVC, or how does a startup know that CVC is the right option for them, as opposed to going to, let's say, a traditional VC investor?
Yeah, so I think there's a couple of different things to consider here. One is, are you a complete solution, or are you a technology? So what I mean by that is, like, I'll go back to batteries. If you're a battery company, which I'm not sure if there's any online here, but if you're a battery company, your battery needs to go into something, right? So you need a partner for that, right? You need a partner to be successful longer term. You need a system to be a part of, right? But if you're a complete product on your own, well, then I guess the real question is, what value is a corporate going to add to you, right? They may be able to make your product cheaper. They may be able to add features to it. And if that's the case, then maybe you can find some good partners out there. So I think if you're a technology versus a full end-to-end system, if you're a technology, a corporate partner may be a really good route to take, especially early. And if you're a full-fledged end-to-end product, then traditional VC may be an easier route to go. I think one thing to consider, though, corporate VCs typically are not in the business of removing the management team and putting in our own team. I think that's something that usually happens more with traditional VCs. We don't do that kind of thing. We invest in great technology companies that have great teams. Part of the reason why we partner with startups is because they move faster than us, and they are not bogged down by the bureaucracy and red tape that we have internally. And so we look at a team's ability to execute as an asset of the startup. People would say, are you gonna acquire the startup you invested in? I'm saying, honestly, if they're still innovating, I would rather them not be a part of our company. I'd much prefer them to stay as a startup and be quick and agile and innovate quickly than be brought into the Stanley Black & Decker umbrella where, that will slow things down immensely, right? So, that's kind of how we look at the relationship. But, I would say that when we speak to startups, I always like it when they come to the table to say, we've thought about how a partnership with us and Stanley could be mutually beneficial, and here are some ideas of how that could work. Whether or not those are the ideas that our business strategy, aligns with or not, that doesn't matter. The fact that they've done some research, put some thought into it, and you can tell that they actually wanted to come and bring something material to the conversation, that matters. And it actually means that you've got a team that knows how to be prepared, that knows, how to work with large organizations. I would highly encourage any startup that's engaging with a potential corporate VC partner to do some homework and try and bring some ideas to the table. Whether or not they're actually relevant in the long run, that's not the point. The point is you did some work ahead of time and showed that you put the effort in.
Yeah, I hear you completely on that. And I really like the distinction. Hi, Vanessa. I really like the distinction of thinking about whether you have a technology or a complete solution, because you're also coming in understanding, by going with this corporate, how's that corporate adding value to my product, and how thinking about yourself as an accelerant, as opposed to, again, trying to replace a solution entirely. I think that makes a lot of sense. And then I also appreciate the coming and doing your homework. I think we all probably get a lot of startups saying, I have the latest and greatest thing, now go find a place to put me within your organization. And that makes it a lot harder on your champion or whoever you're working with at that corporate to really help you if you're not helping them help you. So Vanessa, just to get you up to speed quickly, and thanks for joining. I know we've had some technical difficulties on Hopin this week, but what we've been talking about is kind of flipping to the other side of the coin and really thinking about, for the startups that are listening in, and for startups that are thinking about working with corporate venture capital groups, what should they be thinking about? When is it the right time to approach you as a CVC? I think you may be on mute. No worries. And we can, while we're getting you back on the audio, what we can do is, the other side is, beyond thinking about, for this startup, it's the right time to approach a CVC. It's the right fit to work with a CVC. Just thinking about how a startup might pitch you. How does the pitch process evolve from traditional CVC? How is it different when you're thinking about evaluating a startup and whether it's the right fit for your organization? What are some of the key indicators that you keep in mind that might be a little bit different from a traditional VC?
Well, I would say that certainly earlier on, I've had startups be like, we're raising this much money. It's at a great valuation, good terms. You should get in quick. And here's my pitch deck. And honestly, the deal terms are the last thing I care about in the first conversation. I want to know what kind of company you are. What are your long-term goals? What is partnering with Stanley? How is that helpful to you as a company? What's the state of your product or technology? Help me understand who you are, what your company is doing today, what you're capable of doing today and delivering. Because all I'm thinking about the whole time is how much work is it going to take to get your technology to a point that's commercializable? Because that's what matters to my business units. The farther out you are from production is the longer that it's going to take for any impact to show up on Stanley's top line, and also is going to be a lot of work on Stanley's side too up front between now and then as well. So just understanding like what's the state of the state, right? We can figure out deal terms later once we've qualified you as an opportunity for the business. I think that's like the most important thing is let's qualify you as a fit for our business teams and their programs. That's the first step with the corporate VC, not introducing the terms of your, raise and, whether or not we should be interested in your company based on how great of a deal it is.
And Vanessa, it looks like we have your audio back.
Do we? Can you hear me?
We do. Great.
Yay!
Yes.
That's great. Okay. Sorry about that.
No, thanks for joining us. I'm sorry you're having some of those technical challenges. So we were just talking about, we moved on to talk a little bit about if I'm a startup and I'm approaching a CVC, how does my pitch evolve? It's different. Mike was talking about there's a lot of qualification that has to happen on the front end to understand what's the problem you're solving, where does it fit within the business units. Curious from your perspective, startup wants to pitch you, what are the tips and tricks and how it needs to change?
Sure. So I might use Veeam as an example. That's a company that we invested in this summer. And because we are going through a big merger, we are almost investing right now to save our spot, if you will, to commercialize once we get through the entire merger integration on the back end. But Veeam has continued to work with us since we made the investment in terms of their perspective on what a commercialization can look like. And what's been so great about the way they've specifically approached it, and I think it's a good model for other startups to follow, is that they've been extremely focused on how they add value to our business. So it's not just about them having maybe a product, and they do international money remittance for businesses. So think of Venmo or Zelle, but B2B instead of consumer to consumer. And they do it cross-border using cryptocurrency, which we thought was really interesting. We wanted to learn more about that. And banks today could really only do that with wire transfers or SWIFT transfers. And so it just becomes costly if it's a small dollar amount. So Veeam has already a solution that we know that our customers need. But instead of saying, well, we just have a better solution, it's a better user experience, you should just use our product, it's been really about how can Veeam help TRUIST enhance our revenue at the TRUIST side. So what products and services can we cross-sell through their platform to their customers? How can we make money? And honestly, they were really great about showing projections about how if we were to integrate, not only would we have a better solution to offer our clients with better user experience, but it would also benefit the line of business by enhancing their revenue. And so I think that the takeaway from that is it's not just about you have a better solution or a better user experience. It's really about how you can add value to the organization. And I think that's a pretty critical point because everyone, and I'm guessing even within Stanley, even though there's a focus on innovation, if we can't figure out how to make money doing it, it becomes really difficult to put it into the prioritization pipeline of innovation. So,
absolutely.
And we're even kicking off so many of our conversations now, what's the value case from the very beginning? So really nailing it and honing in on that as the startup before you start having these conversations sounds like a really important first step.
Mm-hmm. Mm-hmm.
Okay. Well, I think we do have a number of questions in the chat. So I know I have one final question, and then maybe we can move over into the chat and get to some of those. But on my end, what I would just ask is, if you are leaving one key takeaway for corporate innovators, I know we've just been talking a lot about, giving some of those tips to startups. But for the corporate innovators that are tuning in, you're both on ventures teams within your organization. How can other corporate innovators within your organizations or within other organizations leverage ventures groups best?
I can go ahead since I've had poor Mike had to talk for most of this. I would say across of TRUIST, all of our corporate innovators have been really accessible. And so that's been fantastic. And so I think it's really important that you're accessible, you're willing to take meetings, you're willing to have conversations. But the thing that separates who we spend the most time supporting versus who we talk to maybe on a quarterly basis is really engagement. And so not only being accessible, but really engaging in the conversation and utilizing the ventures team within TRUIST as a strategic resource that can help you drive your strategic plan is something that I've really have seen the folks we spend the most time with. That's what separated them. They come to us on at least a weekly basis with different ideas, who they're talking to, with their 3-year strategic plan, where can they plug in partners versus building something, and where could they acquire? And so I really think having engagement makes you a great customer, if you will, for ventures, or really enables you to leverage your ventures team to the greatest extent possible, because that's who we're spending the most time supporting right now.
And I would say, first of all, I totally agree with all of that. And I would say, just in addition, I think one of the difficult things that, first of all, I think being on a corporate innovation team is one of the hardest jobs that there is. There's a lot expected of you, and it's extremely difficult not only to invent something new, but then to also then get buy-in from the core commercial team to then go sell it. It's a very difficult task across the board. But I think what the best way from a corporate innovation perspective, I think a great way to leverage ventures is just to understand, how startups are attacking a new market, right? Like, for example, we look at the tool space, in digital tools is a new space out there that, for example, your iPhone comes with an augmented reality measuring app on it for free. And we happen to sell tape measures. So, people are attacking our markets, right? And so our team sees those kinds of trends, and we can be very informative for the innovation team of, here is where we're seeing startups starting to crowd in certain spaces or attack different spaces that look to be, green fields for opportunity. And so we can give a purview to, hey, startups are also innovators. They are just like you. They just don't have all the same resources. Their resources come from privately funded, VC or individuals, and your funding comes from corporate or some P&L, right? But everyone's got money and everyone's trying to drive a solution. So these are other folks trying to innovate in a similar market as you. Here's how they're going about it. And so that kind of just a lens into the competition, I guess, is how they can leverage ventures to their benefit. And sometimes that results in an ideal partnership where, maybe a corporate innovation team has generated some technology that could be essential to something that a startup's trying to do. And they've developed something on the other side of that solution that we haven't even started or thought about. And, a partnership could be the best way for both of us to go to market and both benefit and get there faster. So, it's like I said, though, the corporate innovation teams, I feel for you. You're doing the yeoman's work out there, and more power to you, and leverage your ventures teams as much as possible.
Absolutely. Okay. Well, let's switch over to some of the questions that are in the chat. I'm going to start from the bottom of what I'm seeing and then kind of work our way up, and let's see how far we can get. And for those that we don't get around to, maybe we can post some of our responses in the chat. But the first one that I'm seeing is from Chris Goodman Davis. And her question is, while in recent years, there's been an increased attention on fintech opportunities in the Southeast, in the past, most fintech startups evolved in New York or Silicon Valley, like most tech firms. Have you seen the tides changing with firms you're interested in? If so, what does the geographic breakdown look like in your investment portfolio? Are there territories specifically that you're looking to for investment opportunities?
Vanessa, I'm assuming that's for you.
So no, we are geographically agnostic. So we're not looking specifically for any geographies. Across our portfolio, we're actually pretty geographically dispersed. We've seen a lot come out of Atlanta recently. I've met with a number of fintech companies in Charlotte recently. I recently moved from the Cincinnati area. I mentioned there's a handful of fintech startups in that market. And so I don't disagree with the comment that most of them have originated from New York or the Valley, but we've seen a tremendous amount of activity across the entire United States. In fact, just based upon where there's some other expertise in residence. And we're really hopeful at these technology issues just don't end, but we're really hopeful at TRUIST that as we open our innovation center in 2021, that will continue to drive innovation in our own backyard here in Charlotte. But, certainly we're not at all biased to where we're finding our companies. We want them to be the right fit for our organization. And we're really excited to see a number of companies pop up outside of the more obvious places. And we're hoping to be part of that solution to continue that growth.
Great. All right. So the next one that I'll call out is how heavily are you all relying on consultancies such as BCG to find startups? What is your process for sourcing and vetting startups in a general sense? It's a big question, but I'm curious if you can talk a little bit about how you're sourcing.
Yeah. Mike, you kind of talked about this already. Do you want to add anything? And then
the only thing I'll say is we don't use consultants for deal flow because, that's what we're supposed to be doing. No, my job is a couple of things. One is to evangelize Stanley Black & Decker and just tell people about my company. We're 177 years old, been headquartered in New Britain, Connecticut the entire time, and we do more than just make tools. So it's my job to get out there and explain that to people, and then just to meet people like Noelle and Vanessa and, like I said, university folks, and the incubators in my area, people at Techstars. It's my job to have a network in my region, in my industry, in my markets, and to speak to investors and others to try and find deals. These are private companies. There's not a lot of public information about them. And oftentimes, the best companies aren't always easy to find. And you have to speak to people and network to do that. But, that's what I get paid to do. And I'm not trying to outsource my job. So.
I think that's well said. I agree. We don't hire anyone specifically to source opportunities for us. And we develop broad networks that include conversations with consultancies firms. But in terms of actually hiring them to source, we rely on our own networks. And then also inside the organization, we see a lot of deal flow as well, similar to what Mike alluded to earlier in the conversation. So I won't belabor that point. I know there's a lot of other questions.
Yeah. Okay. So the next one that I'm seeing is, and you all in the audience, please continue to post questions in the chat. But the next one that I'm seeing is CVCs such as Google Ventures are making early stage investments in the tens of millions. Is that activity the new normal? And I guess I would insert kind of a point onto that of, is it normal to be disclosing the amount that you're going to be investing would be my question. Is it fair for startups that don't get that sort of support? Particularly, I think the question is, so new announcements around size of deals or size of funds, also with a focus on women and minority founders. Is this the new normal? Is it normal to be disclosing the amounts that you're going to be investing? And I can pop in at the end of this one.
I can start off here. So Google Ventures, I wouldn't actually consider them a corporate VC. They are just their own fund. They don't have really any relation back to Google. As a matter of fact, I think they invest in a lot of competitive companies to Google. So they don't have that kind of close alignment like Vanessa or I do. I think they're their own entity. And so I wouldn't really classify them in the corporate VC world, even though that's really how it looks on the surface. We certainly don't, talk about how much we put into one company or another. I think you could probably argue that there's not a whole lot to be gained from press releases in general. For us, to me, I don't care if you're blue, green, black, brown. It doesn't matter to me. If you have the best company with the best product and it's aligned with our strategy, that's who I'm interested in. So, that's just our approach. We look for strategic alignment, and that's really the main focus, and that's how we accomplish our goals. We don't discriminate, and we're open to anybody and anything.
Yeah, adding on to that, and this is another example of how corporate venture groups will differ. So historically, both of our organizations didn't have the same view on press releases. One didn't disclose anything, and one was very public about their investment activity. So we've been more public about our investment activity for a few reasons. One, we wanted to let people know that we're in the business and that we're looking for innovation and that we're looking for great companies and startups to work with. And so for Veeam, we actually did disclose in an interview with press at the size that we invested. And generally our investment sizes, will, depending on the company, I mean, they could be 250,000 for a seed stage company up to 20 or 30 million. I mean, there's really no it just kind of, back to Mike's point, depends on the strategic relationship and the stage of the company. But in terms of the imbalance of where the dollars are invested, I think it's interesting because as it stands today, I could turn the spigot on and look for a more diverse set of entrepreneurs and CEOs that are strategically relevant to TRUIST, but it's going to come out in a drip, not in full force. And so one of the reasons TRUIST Ventures is focusing on social change as part of our thesis is because we recognize that we need to create more of an entrepreneurial continuum within the Black, African American, Latinx, and women, and other minority groups, so that we can be part of the solution, so that in 5 or 10 years time, when I turn that on, there's no separate faucet to turn on, right? What's flowing through the door is diverse. And so some of the things that we might support, and as example, might not even be relevant to what we're trying to accomplish strategically across the organization, but are supporting Black and Latinx entrepreneurs and founders, because it's just really important to create an ecosystem where all companies can thrive. So that's something that we're focused on. That's a little bit, I don't want to say it's non-strategic. It's very strategic to the mission and purpose of TRUIST, but it's not necessarily as top of mind because, it's not a product or services that we can offer to our clients. So I think it's a great question, and I hope to see that imbalance start to go away. Over my 20-year career, I've invested in over 50 companies, and one has had a female founder CEO, and the other one had a CEO was a female. But other than that, it hasn't been that diverse. So I think it's really important that we support the broader ecosystem so that can happen.
Yeah, that's thanks for sharing that, Vanessa. I think on that question, there's kind of two potentially different pieces of that question that Rose put in there. The first around undisclosed investments, and I actually read this article earlier this week, which I just posted in the chat, that I found fascinating on, especially when you're talking about corporates, which want to be careful on, what they can disclose around how much they're acquiring companies for, because they don't, they want their shareholders to know that they got a good price. But then on the other hand, you have a startup that wants to make sure that they can, show how valuable of a company they are, or the amount that was raised. So you kind of have this, I think, challenge between motivations and what those two different parties want to put out there. So just posted that, found that to be a really good explanation of why sometimes it's really challenging to know how much startups are investing in, corporates are investing in startups, or that corporates are acquiring startups for. And then on the other side of that, in terms of the new normal, I hope that there is a day when it's not a big deal, when these types of investments and programs are happening, because it is the normal. But I think we are seeing a number of announcements right now. And I hope that, those types of programs continue to, we continue to build these kinds of programs and create more and more opportunities for underrepresented founders. I know it's not necessarily the topic of this discussion, but yesterday morning we were talking with Joey Womack about how to create opportunities for diverse led companies, and creating, initial corporate pilots and POCs. And we talked a little bit about Accenture's new Black Founders Development Program and the launch of that, and just that's not, just around funding, but also access to things like mentorship and access to networks and client opportunities. So I think that there's a lot to talk about on that. But yeah, appreciate, Rose, you asking the question, and we'd be happy to connect more on that one. All right. Well, I know we're starting to get close to time, so I'll go ahead and wrap us up. But thanks, Mike and Vanessa, for joining us. I learned a lot in this conversation, and appreciate you being so open and sharing kind of your perspectives. I think As we've talked about with startups that, are enterprise startups, sometimes it's really challenging to understand, how to engage with corporates and what they're looking for. So appreciate that. I know some takeaways for me, on the startup side was around doing your homework, knowing how you're adding value to the corporate. So I appreciate you all sharing that. But thanks everyone for joining, and hope you enjoy the rest of Startup Week.
Thanks, Noelle.
Thank you.